Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines. Today, we're diving deep into the world of finance, pulling insights from Bloomberg, Barron's, The Wall Street Journal, MarketWatch, and Yahoo Finance UK.
Buckle up. Sounds like we've got a lot to unpack.
Absolutely. First up, it's Election Day in the U.S.
Yes.
And everyone's on edge. The race between VP Harris and former President Trump is still neck and neck.
It's definitely a nail-biter.
Bloomberg, The Wall Street Journal, MarketWatch, and Yahoo Finance UK were all reporting that the markets are reacting to this uncertainty with cautious trading.
Yeah, it's understandable. I mean, this election really highlights how political events can directly impact investor sentiment.
For sure.
What's fascinating, though, is that MarketWatch points out a historical trend. Unified government, regardless of the party in control, has generally been better for the stock market than a divided government.
So maybe a clear winner, regardless of who it is, would actually be a good thing for the markets.
It's certainly a possibility worth considering.
Okay. Interesting. Now let's shift gears to another big story developing today. Apollo Global Management. Bloomberg reports they're making a big splash in the wealth management space,
Oh, yeah.
attracting high net worth individuals and aiming to raise a staggering $150 billion for their global wealth business by 2029.
150 billion. Wow. That's an ambitious target.
It is.
So what's driving this strategy?
Well, Bloomberg suggests it's part of a broader trend in the financial industry. Apollo is going after clients with higher fee-paying assets. And this aggressive target demonstrates the growing importance of the wealth management sector for alternative asset managers.
That makes you wonder about the implications for the average investor. Are we being left behind in this shift toward high net worth individuals?
It's a valid question. This trend definitely raises concerns about accessibility and the evolving landscape of financial services. Okay, let's move on to Boeing. Barron's reports that their workers have voted to end their strike after securing substantial wage increases.
I saw that.
We're talking about a significant jump from around $76,000 to $119,000 a year.
Yeah, they definitely got a big raise there.
Yeah. But is this really a victory for Boeing? Or are there hidden challenges lurking beneath the surface?
That's the crucial question. While the end of the strike is positive news, Barron's also highlights the challenges Boeing faces. In offsetting these increased labor costs, they need to ramp up production to meet demand and maintain quality control, all while potentially developing a new aircraft, which is a costly endeavor.
So it's not all smooth sailing for Boeing, even with the strike behind them.
Exactly. This situation really underscores the delicate balance companies face between labor relations, production goals, and long-term financial stability.
For sure. Speaking of delicate balance, let's talk about some tech giants navigating their own set of challenges. Barron's reports that Palantir is seeing incredible success with their AI technology, which is from Microsoft, despite positive overall earnings. Is facing some headwinds in their cloud computing division, according to both Barron's and The Motley Fool.
A fascinating contrast.
It is.
Palantir's success highlights the immense potential of AI across various sectors and the importance of adapting and leveraging these advancements.
For sure.
Microsoft's cloud miss, on the other hand, demonstrates the fierce competition in the cloud market and the need for continuous innovation.
Definitely. And then we have Tesla, always shaking things up. The Wall Street Journal is examining whether Tesla's entry into the ride-hailing market poses a real threat to Uber.
Right. Well, while Tesla's move is certainly ambitious, I'd say it's more of a long-term challenge to Uber rather than an immediate one. It will be interesting to observe how this unfolds and what it means for the future of transportation, especially considering Uber's partnerships with companies like Waymo.
Yeah, it's a dynamic landscape for sure. Speaking of contrasts, let's talk about Ferrari and Aramco. Barron's reports that Ferrari's stock is soaring, while Aramco is feeling the pinch of lower oil prices, according to the Wall Street Journal.
A tale of two very different companies navigating very different market forces.
Absolutely. So diversification and strategic positioning seem to be key takeaways from this comparison. But before we dive deeper into those insights, let's take a quick look at what Yahoo Finance UK has to say about the U.S. election and its historical impact on the stock market.
Okay, sounds good. They have some interesting data that challenges the current market anxiety surrounding the election. So Yahoo Finance UK points out that while the market doesn't seem to favor one outcome over the other, election days haven't historically been that bad for the stock market. In fact, The S&P 500 has risen on 8 out of the last 10 election days the stock market has been open, since 1980.
Wow.
Even when you factor in the day after the election, the index has only fallen half the time.
Really? So maybe all this anxiety is a bit overblown.
It's certainly possible. Of course, every election is unique, but history suggests that the market tends to find its footing, regardless of who wins.
That's good to hear. That's reassuring. Okay, now let's get back to Apollo Global Management. Bloomberg highlights their impressive growth, reporting that their assets under management have hit a whopping $733 billion.
$733 billion. Wow.
It's a lot.
That's a significant increase, 16%, compared to the same period last year. Their adjusted net income also exceeded analysts' expectations, reaching $1.13 billion. Or $1.85 per share.
Those are some impressive numbers.
Yeah.
Seems like their focus on attracting high net worth individuals is paying off.
It certainly seems that way. Bloomberg states that their asset management fees increased by 10% year over year, and fee-related performance fees saw an even bigger jump, up over 40%.
Wow.
And get this, their total capital raised from wealthy individuals this year has already surpassed their total for all of 2023.
That's pretty impressive. It sounds like Apollo Global Management is a company to watch in the coming years.
I agree. Now let's circle back to Boeing. Barron's mentions that the company is taking steps to address those cost challenges we discussed earlier, particularly the substantial wage increases.
Right. They're in a tough spot.
Exactly. Barron's reports that Boeing has announced plans for around 17,000 layoffs.
17,000.
Targeting executives, managers, and employees. They believe this move will help them save between $1 billion and $2 billion a year.
Wow. So they're trying to streamline their operations, become more efficient.
Exactly.
But 17,000 layoffs, that's a lot of people.
It is a significant number. These layoffs,
Yeah.
combined with the end of the strike, are crucial steps towards stabilizing their financial position. But it remains to be seen whether these measures will be enough to offset the long-term impact of those wage increases.
Yeah. It'll be interesting to see how this all plays out. Now let's turn our attention back to the tech sector. Barron's reports that Palantir CEO, Alex Karp, is incredibly bullish on the future of AI, particularly its role in shaping global power dynamics. He made a pretty bold statement, saying, "The world will be divided between AI haves and have-nots. At Palantir, we plan to power the winners."
It's certainly a provocative statement, but it reflects their confidence in the transformative power of AI.
Yeah.
Palantir has carved out a unique niche for themselves in the AI landscape, focusing on providing solutions for government agencies and large corporations.
And their success is undeniable. Barron's also mentions that Palantir has boosted its fiscal year revenue guidance, signaling their continued growth trajectory.
That's a positive sign for them. Now, shifting to Microsoft, we mentioned earlier that they missed expectations in their cloud computing division. The Motley Fool suggests that rising competition from Amazon Web Services and Google Cloud is a major factor in this.
Yeah, it sounds like the cloud computing market is becoming increasingly crowded. So how is Microsoft planning to stay ahead of the curve?
Well, the Motley Fool reports that Microsoft is leveraging its diverse business model, particularly its strength in productivity software, like Office 365. They recently introduced Copilot, an AI assistant for their Office suite. And they're betting that integrating AI into their existing products will attract new customers and drive revenue growth.
That's a smart strategy, using their existing strengths to tap into the potential of AI.
Yeah.
It'll be interesting to see if it pays off in the long run.
Agreed. Now let's revisit Ferrari and their remarkable success this year. Barron's attributes this success to their unique positioning in the market. They've really transcended the automotive industry and entered the realm of luxury goods.
That's true. Owning a Ferrari is more than just owning a car. It's like owning a piece of art or a high-end fashion item.
Exactly. Their focus on exclusivity, limited production, and high-end customization caters to a very specific clientele, those who value prestige and are willing to pay a premium for it.
Right.
And this approach has shielded them from some of the economic headwinds affecting other companies, particularly those heavily reliant on China's market.
Barron's highlighted that Ferrari sells less than 10% of its cars in China, allowing them to easily shift inventory to other markets if demand weakens.
Right.
That's a strategic advantage.
Absolutely. Their independence from any single market gives them remarkable resilience. On the other hand, as we mentioned earlier, Aramco is facing challenges due to the fluctuating oil market. The Wall Street Journal reports that their third quarter profit took a hit, falling to $27.56 billion from $32.58 billion the previous year.
Oof. That's a pretty significant drop. What factors contributed to this decline?
Well, the Wall Street Journal attributes this to lower oil prices
Hmm?
and weakening refining margins, which push their downstream division, the part of their business that processes crude oil into usable products, into a loss.
Hmm.
And to add to their challenges, global demand for oil is facing headwinds. Both OPEC and the International Energy Agency have trimmed their demand forecasts for a third consecutive time. It's not good. The Wall Street Journal mentions slower demand in China as a contributing factor to this global trend.
Right. China being the world's largest crude importer.
Exactly.
Yeah.
Any slowdown in their economy has ripple effects throughout the energy sector.
Makes sense. It seems like Aramco's challenges highlight the vulnerability of companies, heavily reliant on a single commodity, especially one as volatile as oil.
Absolutely. It underscores the importance of diversification and adaptability in navigating today's complex economic landscape.
Okay. Now, before we move on from the U.S. election, MarketWatch brings up an interesting point that many investors seem to be overlooking. There's a lot of talk about the potential negative impacts of a clean sweep by other party.
Right.
However, MarketWatch reminds us that historically, unified government, regardless of which party is in control, has actually been quite positive for the stock market.
That's a valuable insight. MarketWatch cites data going back to 1928, showing that annualized returns for both unified Republican and Democratic control have consistently outperformed periods of divided government by at least 2 percentage points.
Wow. Perhaps a sweep isn't such a bad thing after all.
It certainly makes you think twice about the common assumptions surrounding election outcomes.
Yeah. So the message here is to stay calm. Look at the long-term trends, rather than getting caught up in the short-term noise surrounding the election.
Exactly. And speaking of long-term trends, let's shift our attention to a sector that's constantly evolving, the ride-hailing industry.
Yes. The ongoing battle between Uber and Lyft, and the looming threat of Tesla's robotaxi ambitions. What insights does the Wall Street Journal offer on this dynamic landscape?
Well, the Wall Street Journal suggests that Tesla's foray into ride-hailing might not be the immediate threat to Uber that some believe it to be.
Yeah.
While Tesla has ambitious plans for a self-driving taxi service, they still have a lot of technological and regulatory hurdles to overcome.
Makes sense. So Uber can breathe a sigh of relief for now.
Perhaps. However, the Wall Street Journal also points out that Uber faces other challenges, particularly rising insurance costs, which are impacting their profitability, and those costs are ultimately passed on to the consumer, which could lead to decreased demand as people become more price-sensitive and opt for alternative modes of transportation.
Right. It's a tough balancing act for Uber, maintaining affordable prices while managing their costs in a highly competitive market.
Indeed. Now, the Wall Street Journal also mentions a new development that could shake up the ride-hailing industry, a partnership between DoorDash, the food delivery giant, and Lyft.
DoorDash and Lyft, that's an interesting combination. So they're combining food delivery with ride-hailing.
Exactly. They're offering a bundled service through DoorDash's DashPass membership program, giving customers access to both food delivery and Lyft rides.
That's a pretty compelling proposition. You could definitely give them a competitive edge over Uber.
It certainly could. This partnership highlights the growing convergence between different service sectors as companies seek to expand their offerings and capture a larger share of consumer spending.
Yeah. It's a trend we're seeing across various industries, from tech to retail. Yeah, it'll be fascinating to see how this partnership plays out and how Uber responds.
Indeed. Now, while Tesla might not be the immediate threat to Uber that some perceive it to be, the Wall Street Journal points out another player in the self-driving space that's making significant strides: Waymo, Google's self-driving car company.
Oh, right. They've been relatively quiet lately, but they've been working on this for a long time.
They have, and the Wall Street Journal highlights their progress, noting that they've managed to significantly reduce wait times for their robo-taxis, making them increasingly competitive with Uber and Lyft in certain markets.
And interestingly, Uber has actually partnered with Waymo.
They have. It seems that Uber is hedging its bets, recognizing that self-driving technology is likely to play a significant role in the future of transportation.
So they're collaborating with a potential competitor, rather than fighting them head-on. That's a smart approach, acknowledging that the transportation landscape is constantly evolving and requires flexibility and adaptability to succeed.
Absolutely. Now let's circle back to the world of finance. Bloomberg reports that Schroders, the asset management firm, is facing some headwinds. They've reported a significant outflow of funds, totaling £2.3 billion, or $3 billion in the last quarter. And they're forecasting even more outflows, potentially reaching £10 billion in the coming months.
Wow. That's a lot of money leaving their management. What's driving these outflows?
Bloomberg attributes it to a combination of factors, including the expiration of legacy mandates, which are essentially contracts for managing large pools of assets,
Right.
and a challenging market environment overall.
So it sounds like investors are pulling their money out.
Yeah.
Seeking better opportunities elsewhere.
That seems to be the case. This situation underscores the competitive nature of the asset management industry, where firms must constantly adapt and innovate to attract and retain investors.
It's a reminder that even established players can face challenges in a rapidly changing market.
Precisely. Now let's shift gears to a company that's embracing a very different strategy, Nintendo. Bloomberg reports that they've made the difficult decision to slash their full-year outlook.
Really? What prompted this change in outlook? Has the gaming market slowed down?
It seems that demand for their Switch console, which has been a massive success for them, is starting to wane.
Okay.
They've reported 5 consecutive quarters of declining profits, leading them to adjust their expectations.
So the Switch's reign might be coming to an end.
It's possible, but it's important to remember that Nintendo has a long history of innovation and reinvention.
Right. They've always found ways to surprise and delight their fans, so I'm sure they have something up their sleeve. Now let's wrap things up with a story that highlights the power of collaboration and the potential for positive change.
Sounds good. What do we have?
Yahoo Finance UK reports that Vodafone and Three, two major telecommunications companies in the UK, are on the verge of merging.
Yeah.
In a £15 billion or $19.5 billion deal. That could reshape the UK's mobile network landscape.
Wow. That's a significant development. It sounds like a potential game changer for the UK telecoms market.
It does. And it seems like this merger has a good chance of being approved. But there's a catch.
What's that?
Yahoo Finance UK reports that regulators are likely to approve the deal, only if Vodafone and Three commit to investing heavily in upgrading the UK's mobile network. They want to ensure that this merger leads to tangible benefits for consumers, not just increased profits for the companies involved.
That's a smart move by the regulators. They're leveraging the merger to drive improvements in infrastructure. It sounds like a win-win situation, a stronger, more competitive telecoms market.
And improved mobile service for consumers. Exactly. This merger highlights the potential for collaboration to drive progress and deliver tangible benefits to both businesses and consumers. It's a positive note to end our deep dive on.
It really is. It's a good reminder that even amidst, uncertainty and competition, there's always room for progress and innovation.
I love that takeaway. Collaboration and a focus on the bigger picture can lead to some really positive outcomes. Well, that was quite a journey through today's financial headlines. From elections and strikes to AI luxury cars and the ever-present influence of the oil market, we covered a lot of ground.
We did, and it's fascinating to see how all these seemingly disparate stories are actually interconnected. It highlights the complexity of the financial world and the importance of staying informed.
Absolutely. It's more important than ever to think critically about the information we're consuming and to consider the long-term implications of these trends. What stood out to you the most from today's deep dive?
For me, it's the contrast between companies like Ferrari and Aramco. Ferrari's strategic focus on a niche market has shielded them from economic volatility, while Aramco's dependence on oil prices has made them vulnerable. It's a powerful lesson in the importance of diversification and adaptability.
That's a great point. It's a reminder that even in uncertain times, there are companies and sectors that are thriving. It's all about understanding the forces at play and making informed decisions. And speaking of informed decisions, I think we've given our listeners a lot to think about today.
I hope so. The key takeaway is that beneath those headlines are real people, businesses, and global trends that are shaping our world.
Couldn't agree more. Well, that's all the time we have for today. Thanks for joining us on this deep dive into the world of finance. We'll see you all tomorrow morning with a fresh batch of headlines from major financial magazines.